We like to invest before that all clear sign is out, because once that happens, prices tend to move quickly. The good news is inflation is coming down. The Federal Reserve is going to stay vigilant. I think they're going to keep rates at an elevated level for an extended period of time because they do not want inflation to resurface. The weight of those high rates, combined with the caution in the banking system, will weigh on the economy. People tend to focus on financing availability for whether it's a good time to invest capital, and it's actually the opposite. In a world like we've been in, where financing's hard to come by, you tend to pay less. Purchase price is permanent. Your financing's temporary. At some point, markets will normalize, cost of debt capital will come back down, and you'll refinance that capital structure. What's interesting about real estate today is I think the headlines are universally negative, but what's happening on the ground is very different than that, much more nuanced. I think everyone knows the office market here in the United States is really tough. High vacancies, declining values. On the other hand, if you look at areas like global logistics, student housing, or data centers, we're seeing much lower levels of vacancies, strong underlying fundamentals. Given what AI is going to do, you want to be ahead of it. We started back in 2015 building up our data science team. If you're in an industry and your competitor is using AI tools to create a product or to drive efficiencies and you're not, you're going to be at a real competitive disadvantage. If AI is about data, being the largest alternative asset manager in the world with more than $1 trillion of assets, we have all this proprietary data. I think we're going to be able to harness that to make even better decisions about how we deploy capital. And that's what gives us so much optimism about the future.